All right, good morning, everybody. Let's see the hip piece that came out Friday afternoon, picked up traction over the weekend. Keep in mind, this whole move isn't just connected to that deep sink hip piece. It was also tariffs that were put on and then taken back off again. That's a part of the new administration's stick and carrot maneuver when it comes to countries who don't want to take back migrants that are being deported. So markets are down around the world. Keep in mind, China is closed from the 28th to February 4. They'll open back up on the 5th. They're going into their new year. My expectation was when we come out of the new year, we'll start to get that ramp up leading into their March meeting, where it's expected that they're going to put a bunch of stimulus into play. Now, whether or not that turns into buy the rumor, sell the news or not sure. But buy the rumor would still match buying into China after we get back on February 5. Baba, Baidu, JD, PDD, all those guys, right? So when we look at what's up this morning, that's Hong Kong and everybody else is down. Now, they were down more. We've already started to bounce back a bit. Spot Gamma has released their founder's note, the AM edition. Certainly worth a read. They were talking about, they started to see put sellers already around that 5,900 area. So if we happen to drop back down and break 5,900, then they expect a test of 5,800 put wall. Something to consider. So we're going to get some auctions today, 11:30 and 1 o'clock. Like I've said before, if you have any auctions, whether they're at 11, 11:30, or 1, just assume that the other time frames have it too. They don't mention auctions at 11 o'clock here, but I would watch for 11 o'clock anyways. It's a really big week, all things considered, and this is certainly a rough start to the week. Don't forget, we got earnings kicking off, really starts to get big this week too. Meta just on Friday increased their capex another 25 billion, which has been the theme with all of these big names where their mantra has been, no matter what it costs, we want to be the leader and we're going to spend whatever it takes. Right in front of this data that came out on this deep sink, which that thing didn't spring up overnight. It's been around since 2023. Its last big update was in December 2024. They just happened to throw that hip piece out there right before China went on holiday. Fun times, right? So 8:30, 10, 10:30, 11, 11:30, and 1. Once we get past 1 o'clock, we really don't have anything else for the day. If you haven't heard me say it before, try to break your trading day down into two parts. You got your morning session and your afternoon session. And if you're a futures trader, then it's three parts, right? You got the pre-market, the morning session, and then the afternoon session. But for 0-day options trades, if you're trying to run a 0-day options trade, run a morning trade and then run an afternoon trade. There's a lot of research behind that, which, to be fair, I came out with that on my own. I just recently found out Tasty Trades has done a bunch of research on 0 days, and I heard Tom Sosnoff saying the same thing. I love it when I get confirmation of something that I do from another resource. So if you haven't come across that and you're trading options on a 0-day basis, check out their research, because they've certainly put a lot of time and money into finding some edge there. So we're below the volatility trigger, the 0 gamma, the 10-day, the 10-week, the 20-day. I mean, we cut through everything. We are far below the average daily range, and we're still not at the put wall. So while the founder's note was talking about the SPX, we're looking at the ES, and we can see that put wall 58.34. Now we hit a red line here. It's another option level. We've got a voodoo line and an options level 58.50. We basically bounced on 59.50. We got 59.32 cog line, 59.11, 5900, and 58.92. So all of those levels are in play as well. Otherwise, if this is kind of my failed flag setup, then we should be able to snap the lines, develop a 786, look for a breakover, which would basically build us up into a big cup shape, right? That'd be the left wall of the cup. We have a base, and then we'd run back up the other side. Failed flag. We can see the floor pivot, 6096 way up here, and the channel that goes with it. We've already hit it and cut through it. We're far below it. Now, I'm thinking that's the weekly floor pivot. So we're underneath that weekly floor pivot. On the daily pivot, we opened underneath it. We haven't hit it yet. So that's an MDP, missed daily pivot. It's a narrower channel, which would imply that if we broke out, it would have legs, but we already see that. That's not much of a surprise. The question now is if we're going to flip and be able to run it back up. Even on that run back up, the argument is the run back up a dead cat bounce? Is it just to run up to close the liquidity gap, or are we running back up because the market overreacted and it's just trying to get back to where it normalizes? There's no way to answer that yet, by the way. We have to let things unfold a little bit before we can begin to answer that question. We have a volume profile from 2 weeks ago. We cut through it before we're getting back above it. That's the problem when you have such a violent move. Nothing will get in the way. It'll just run right through anything in its path. But now that we've calmed down a little bit and we've started to get back above it, it's kind of the level we want to keep. So 59.87. Otherwise, when we zoom out, we do have a level back here with 2 points of control. that create a little bit of a zone, that 59.50 area. Now, last week, we were looking at the 10-day, which we're going to get there in a minute. The point of control so far on this move, and it's only one day, right? This is a profile for a whole week. We're just looking at today's profile, the start of the week. The point of control is still way up here at the top. We haven't built out enough volume down here where we're at to move it down. That's one thing that I would be looking for this morning if we're going to expect this turnaround to hold even for a day. Remember, we can turn around for 2 or 3 days as we bounce up and then roll over and sell off more. So don't believe that all this is done just because we hold this low and don't continue falling today. But it'd be a good start to see this point of control come down and get with us or underneath us. So that's one thing I've got my eye on this morning. As you would expect, we've got elevated volume this morning. I can't remember the last time we saw that much volume on the overnight, right? This is cumulative volume that starts at midnight. I think I may have a new record. I haven't seen these sort of levels since COVID. It's that extreme. Thinkorswim's a little janky this morning. I half expected some of that volume, a lot more of that volume, to be on the next contract, but it is still on the front one. Mostly. All right. So this is the 10-day we were talking about it. We talk about it every day, and how we were looking for the TPO's point of control to shift and adjust. We could see the point of control moved up, just like on Friday we were talking about having it move up there, but it doesn't match the TPO, right? So TPO is basically trades, and volume profile is obviously volume, word is in the description. So we had a lot of volume up there, but it didn't take a lot of trades to get that volume up there. That's why we show both of these at the same time, right? Knowing that we got a lot of volume up there is one thing. Understanding whether or not it was a lot of small trades that generated all of that volume or just a couple of really big trades. And that's what this is telling us. And we're still going to lose these. We're going to lose these candles on the left for each new candle that we get on the right. And really the bulk of the volume that we're looking to get rid of is Wednesday, Thursday, and Friday. So we've got days to go before we start to address this volume. We won't even get near it, right, for a couple of days. So the only way that we're going to see this TPO move up is if price was to make it all the way back up there and start putting in some work. Otherwise, at our current location, we're building out more volume at the same spot that we were looking to lose volume. All right, we took out the VPOC from the 21st, so that's gone. And on Friday, in that move to the downside, we took out the VPOC from the 22nd, so that's gone. But we're going to take that one from the 22nd and apply it to Friday and just get rid of this one from the 21st. Close enough. So that's our new VPOC. If you haven't heard the phrase before, it's untouched point of control. Now the textbooks will tell you to do this every day, right? Carry forward the value area high, value area low, point of control, whether or not it's been hit. I've got enough pivots, I don't need more. I just keep track of the one that hasn't been hit yet. So for an example, there's one back here. I don't know, yeah, that one that I had taken off. We had been carrying this forward every day because price had not hit it. Today, it ran down and it hit that spot. We don't need it anymore. I'm going to take it off. This is the weekly expected move. Now on Friday, we typically examine this as a preview because Friday mornings, it's not set in stone. But last Friday, we were only getting the gray line. I don't know if it was a think or swim issue or an indicator issue, but it wasn't showing the range. So we don't know how much the range changed between Friday morning and the close of Friday. But we got the new week. And one thing that we can do with that is compare it to the previous week, kind of see, what's the volatility look like between one and the other. So easiest way to do that without nerding out too deep is just randomly draw a box on it and pick it up, set it on the last week. We can see that these 2 weeks, they're about equal. So the current week that we're in, it didn't really have a whole lot more projected into it for volatility than last week did. But you can see we're already outside the entire week's range, right? This is how far we should have traveled for the week, and that we should have closed inside this box with a 1 standard deviation accuracy. So 68 point blah, blah, blah. It's round up. We usually just say 70% chance that it closes in the box. But that 1 standard deviation, or that 70%, that's for normal things. And the S&P has a history of accuracy when it comes to its expected move, that it usually closes inside the box 80% of the time. The easiest way to do that, if you're checking its current accuracy, is just to count back 10 weeks and see how often on Friday at the close that it closed outside the box. If you count more than 2 out of 10, then it's not holding its 80% accuracy, right? So it's something to consider that we've had a number of weeks recently where we've closed outside the box. Take last week for an example, we closed outside the box. And the week before that, we closed outside the box. And the week before that, we closed outside the box. That's 3 weeks in a row. Now, to be fair, I don't generally use holiday weeks when I do that, because holiday weeks are always janky. It messes with expected move. But even if we didn't count that and we looked back over 10 weeks, I bet we would still find that we've been closing outside the box more than we're supposed to. And it's just a hint about the risk out there, or the danger that the market is either mispricing volatility or it's outrunning the projections in volatility. And it's usually a really good warning. For an example, before COVID hit, if you were trading back then, after it hit, there was a lot of people who said, well, there was no warning, it just hit us. And that wasn't quite true. There was warnings in skew, there was warnings in volatility, and one of those warnings was in the weekly expected move. And the model was being broken consistently before the dump. So, warnings come and go. And then, of course, you end up being the guy who cried wolf too many times, pointing out warnings that don't turn into anything, and just being some perma-bear that nobody wants to listen to because all you always sound like is doom and gloom. So I'm just pointing it out. It's just a data point. We are breaking the move model consistently and consecutively, and that's a big heads up that you should be a little concerned. Generally, what that means for me is I just close things a little sooner than I normally would, right? If my options trades are 60-day trades and I generally close them at 50 to 60% profit, then I'm closing them at 40 to 50% profit. Instead of using 15 lots, I dial it back and use 8 to 10 lots. Just reducing my risk, right? Doesn't mean I'm going to sit out and not participate. So we are back down below the 10-day. I mentioned that earlier. If we're looking at the wave, even though this is a really ugly looking wave, I did mention last week how we were on the way back. Wasn't expecting this, obviously. I don't think anybody was expecting this. But we were expecting the wave back down. It just happened to get there a lot faster than we were expecting. We're at 0.7% below the 10-day moving average. We've been much deeper than that. How long we stay under here is going to be kind of the whole thing, right? Whether this is just going to be a small dip and we're back up again, or if it's going to be something a little more sustained where we spend a lot more time down here. If you're looking at how far we fell on the day, if I put this same model on an hourly or maybe even a 30-minute, then we would be way oversold. And we would be talking about how it owes us some sort of mean reversion, least squared method, dot plot statistics, flip back the other way like a V bottom or something. I don't put it on the hourly or the 30-minute. Run it on daily and weekly. On the weekly, we're back to flat. So we're nowhere, right? On the daily, we're not overbought to a deep enough degree that we would expect some sort of mean reversion back up in the other direction from being, quote, oversold. Not on a daily model. So on the intraday, sure, I mean, you can't miss that deep drop and the way it's trying to mean revert right now back in the other direction. But on the higher time frames, if we're looking at this sell-off thinking it's already done a lot and that it owes us some sort of bounce back on the higher time frames, it hasn't even gotten started. The move hasn't registered on these charts yet, but I want to show it this morning because I think looking back, say a week from now, we're going to want to know what these look like before the news really registered on these. This is a daily chart on all of these, and Thinkorswim doesn't update its daily charts with pre-market moves. So all of that hasn't hit these. The label in the corner is showing a 5-day move. And you can see how we had all of the 9 sectors that we tend to pay attention to. Top 3 are risk on, bottom 3 are risk off, 3 in the middle are the midline, And we had 8 out of 9 all in the green, with some of these up more than 2%. Healthcare almost 3%. Finance 1.25%. Tech 2.25%. Industrials almost 2.5%. Even staples and utilities, up more than 0.75%. So, the rally that we've been saying needs to spread out into other things because it was too crowded. It was all AI, chips, Mag 7. It had started to spread out a little bit. Now, of course, the utilities goes back to uranium, energy for data centers. So it's really just an AI trade after all. And a lot of the healthcare has been tied back to, the AI and biopharma. But still, industrials, staples, healthcare, utilities, building materials, is starting to spread out. So we'll see how much of that gets whacked. I'm sure we'll have to revisit this later in the week, see how much this move really affected everything else. I think we'll start with what's up this morning since it's, likely the smallest, easiest list to deal with. China's up. We can see that if we're looking at MCHI or KWeb, which is what I generally look at if I'm trying to see what China's up to. Usually we would see emerging markets up here too, and emerging markets is basically China. And we would see solar, but solar is way down here, not getting anything. That's a bit of a surprise, really. And we've got real estate and staples up this morning. So, we were just looking at all those sectors and talking about how the rally had started to spread out into everything else. Well, real estate isn't on that 9 grid, but staples is. Both of those are up. The benchmark that we use is 0.5%. Because I do the morning briefing so early. And my goal in teaching people how to do a morning briefing for themselves is so that you can look at things that you want. All right. This whole thing that I do is just about teaching you how to do it for yourself. If you're running your morning briefing closer to the open, change the benchmark. Don't use 0.5%. Use, say, 1% or even 1.5%, depending on how close to the open you are. But at 8 in the morning, 0.5%, it works for me. It's been my benchmark for years. But if you're doing it at, say, 9:15 or 9:20, you're going to want to narrow your list down significantly because you don't want to try to trade the open with a trade list of 35, 40 names. A 2% benchmark would narrow your list down significantly. So looking at things that are down this morning, it'd basically be everything is the easy answer, but it really isn't, right? Because we were just looking at staples. So we got gold miners, precious metals, communications. The Mag 7 group collectively, tech, Bitcoin, we're going to feel that. Uranium as a part of the AI data centers, semiconductors, just about what you would expect. And it's not we've seen that split between technology names, like software names, and chips. It's been that fight for a while, right? Almost a good pairs trade. But right now it's software and chips getting whacked. So nice move in bonds. Hopefully, you started to play that turnaround in bonds from last week. There was some people that were talking about this inverse head and shoulders too. I mean, yeah, head and shoulders tend to be the butt of all jokes. Hopefully you have a reason for it turning better than just, oh, well, it's a head and shoulders out here on a daily. But we are getting that turnaround. I don't like the huge gap that we left behind. But if we're looking at it on a weekly, weekly gaps are a powerful thing. So we got bonds up. Of course, we got China up, whether it's FXI or KWeb or emerging markets, solar. It's just really surprised we're not seeing solar yet. Staples. I broke it. We got real estate and healthcare. Well, healthcare's not at our benchmark anymore. So maybe everything was just updating here. It stops at Staples. There was some questions on the carry trade. This is peso yen. It's a common carry trade proxy. Looking at this, trying to gauge the impact. I think this is just getting whacked along with everything else. Right? I don't think we're seeing an unwind in that space. They did raise rates, right? But they telegraphed it so well. They do a much better job than our Fed at communications. That they raised that rate hike last week, that quarter basis point, and we didn't get this reaction. So if we didn't get it then, which is where we would have expected to get it, then we can't look at this now and say, oh, it's a part of the unwind. I don't think so. That'd be like getting FOMC on Wednesday and then on Friday starting to see a reaction and say, oh, well, that's from FOMC. Not likely, right? Not likely. I've been wrong before, so, it'll happen again. Maybe I'm wrong. I think this move is just a part of everything else that's moving. And speaking of everything else, we kind of touched on it with TLT being up, but you got 10-year breaking down, getting really close to that 4.5. It's likely going to bounce there. We got the dollar breaking down into 107. It's likely going to bounce there. And we got the ES struggling to get back above and stay above 6,000 because it did bounce. Now, at first glance, with all three of these pointing to the downside, you may think they're going to bounce together and then they're going to fall together again. I'd be leery of that. If we bounce at 107 and 4.5, it's very likely going to be the next rejection to the downside in the ES. And then these two are going to do their own thing, heading back up on the bounce, while the ES does its own thing, heading continued move to the downside because they bounced. That's my first take on it. Now, through the day, we're going to see all of this begin to normalize, and then we'll have a clearer picture. But that's my best case right now, is that they're going to find support and bounce, and that the ES, which already had found support and bounced, is just bouncing into resistance before it rolls over and legs down again. We'll see. If these just find support and don't rip hard to the upside, say they just find support and stop falling, we don't have to leg down deeper in the ES. All right, the move that we've seen is not, don't expect it to be there, right, on the daily or the weekly. If you're using Thinkorswim, right, you can see how the SPX, which isn't open yet, is still showing that breakout, those new highs, closing up, having gotten through all of these levels of concern. We've got these lower gaps that are worth considering. They're very likely going to be over our head on some of these now. When it comes to a weekly gap, we had one down at 6,000. Spot Gamma was talking about 5,900 is where they saw some put selling this morning, and that we were rising up off of that. You think about the ES and it's moved back up, and that 5,800 was their next spot if 5,900 breaks. So this is where the SPX is at this morning, way down in this area somewhere, that 5,950, 5,900. When you think about the ES as the proxy. $5,800 would put us down into the second week of January. And if that breaks, then we're going back down to 57, cog line 57.11. All right, guys, watch the clock. Keep your eye on the news. Look for all of this to start to normalize a little bit. Keep in mind, China's going to be closed for a week now, from the 28th to the 4th. I'll see you all tomorrow.